Marty, once again, thank you for such a great forum. It's been terrific. Yesterday was amazing, and today started out well, and I hope that we continue that. So I'm going to let everybody introduce themselves. I think that's the best way to do it. So we're going to start with Chivalry. Andy, you're first.
That's the modern way to do it.
That's right.
Long story short, this will be my 40th year as we'll just call it professional investor. Never been on the sell side. I'm actually awful at selling anything. But I got in the business, somebody said 90s. Let's just go back a decade or two. I got in the business because I was an econ major that was a really good computer program. And at the time, maybe this guy over here, it was not common. We were trading futures on index cards and throwing them into a pit if you ever saw trading places. So, and those are my friends in the movie, by the way. Anyway, so that's how I got into it. And I was a prop trader for 5 years and full of European investors 4 years ago, no Americans. So I gave them my trading software, they got to know me. They said, do you want to run our US hedge fund? This is a closed loop. This isn't like signing it up. Don't turn it down, you're 30 years old, some of you do hedge fund. But also then I knew technology, so I started investing in public tech. Michael Dell's a year out of the garage. And then people started sending me venture deals in tech so I could read them and understand. So it's a family office. I mean, we just, oh, well, we could do venture, sure. So I started doing venture deals, semiconductors, technology. That evolved into a separate venture capital fund. Then I hedge fund, and I stopped actually that, and I did just venture capital till the dot-com boom bust. And the problem wasn't the companies. The problem was nobody would invest. And for a lot of personal reasons too, I flipped the doors and I went to State Street, the polar opposite end of the planet. But the good opportunity for me was they didn't have anything or knew anything about hedge funds. So in 2004, I could pretty much do it the way I thought it should be done. And 13 years later, we have a dozen performance awards. We raised billions of dollars in spite of my awful ability because we had a sales force. And so manager selection, technology, integrating all these kinds of things. And so to the last point, we hedged Brexit, not because I knew what was going to happen, but because if you looked at the options market, you could buy leave very cheap, and that was the bigger risk, and you didn't buy stay. I don't know how AI is going to figure that part out because I didn't know what the outcome's going to be. I just knew what I could hedge. So you combine all the quantitative, the qualitative. We were third quantitative funds. Michael Weinberg, we know each other through that. But our credit book was the best. Did big short, did distressed, all kinds of creative things that funded hedge funds were not doing. So 2015, State Street decided that everything had to be a registered investment company. I don't know, somebody in the bank. Scott Powers, the CIO of SSJ, left, and I went back to privates and family offices. So we'd already been doing specialty lending, by the way, 12 years ago, and things of that nature. And so I'll turn it over to Marie, who was our attorney and got to sit in the room with me, arguing with people over sub-advisor agreements.
So my story is, I think, a lot more boring than Andy's.
We could start before we met.
I am the co-chair of the investment management group at Lowenstein Sandler. As Marty mentioned, we've been involved with the Ivy groups for a long time, probably 20 years.
About 20 years, yeah.
I've been at Lowenstein now for about 25 years. And I do three different things. I launch funds of all kinds: hedge funds, private equity funds, venture funds, real estate funds, funds of funds, secondaries. But I personally focus on venture funds, so I do a lot of those. I also, from the LP side, institutional LPs, I review documents, and that I guess pertains to this panel, right? Choosing managers. I can speak about it at least from the legal side. And then the third thing I do is that when executives are joining funds or leaving funds, I help. We have an employment group, but the economics are so tricky really with the funds that it makes more sense for the investment management people to do the first draft of any agreements and then to bring in the employment folks. So that's really my story.
I was gonna say,
Long association with Marty means that you're an Ivy-covered institution, right?
I guess, yeah.
Well, actually, I mean, she went to Cornell and Yale, so
I
yeah.
went to Cornell and Yale, but I went very, very late in life, and that's really the
well, I was gonna say,
first
so
story.
I was gonna say, go way back. We've actually known each other 20 years, so it is
Right.
way back.
Right, and I was an
do you wanna-
econ major too.
Do you want to check what's going on with the computer?
Oh, I
Says
haven't done
signed
that.
out.
Unmute to start speaking.
Signed out.
That's not good. Maybe that's why.
Oh, because there's people
I don't know.
on
They
the.
can't hear us.
No, he can handle it from there.
But see, Andy's a technology guy. It's a
I can press a
technology
button
guy.
too.
Are we back?
Okay.
Oh, now we're echoing again.
Somebody else is logged in and have their volume, they turn their volume up, their microphone and their speakers.
Maybe I shouldn't have unmuted that.
Yeah, you shouldn't have
unmuted that.
Yeah, no.
You shouldn't have unmuted that.
I'm just here for the channel.
Oh. So.
On the table in the back.
Oh, geez.
Better?
No.
You have to hit the Zoom button.
No, it's went away. The bottom right.
And it's,
Got big eyes.
Sounds like a reading. No. It disconnects.
So you're on. Right now.
Hello?
Okay.
Scott. No. The Zoom is
There is an echo still.
the blue thing at the bottom.
We use the audio.
Click that.
Is it on now?
No.
Mute yourself on that. You can mute yourself.
Yep.
All the sound goes through the ceiling.
Can't see that. Our screen is different.
It's on the,
Right there.
I started out in investment banking and in public finance, and then segued into private clients when that went the way of the buggy whip. It happened coincidentally, I ended up in the high net worth arena. I was at the Swiss Bank as a director of private and trust banking. I was at Bear Stearns, Morgan Stanley, et cetera, et cetera. And ultimately, I found that my hands were tied in manager selection to a certain degree, in that I was encouraged and penalized if I didn't sell the soup du jour, so to speak, or tout it. And ultimately, 12 years ago, I started my own business, since I felt like I had enough people that I could go to that I knew were interested in alternatives, things that you couldn't find readily on the internet. I wanted to find little nuggets that I thought would be exciting, different, and appealing to the clients that I knew. And so that's basically what I do. I consult to family offices and introduce them to very interesting alternatives that I find I would put my own money and put my family's money in. And it's the hard part about manager selection for me is that we talked about this earlier, and Marty alluded to it. There's a lot of due diligence. I am licensed and I'm held to a higher power, if you know what that means, with FINRA and SEC, where I really do have to kick the tires. I can't have someone come to me and say, hey, I've got a great idea. Can you help me? I really have to meet management. I have to go to their office. I have to study the balance. There's a team at my broker dealer as well, but it's a lot of hard work. So it's not just, hey, you seem like a great guy. I know people with a lot of money that threw money in your deal, cocktail due diligence. No, there's real stuff that has to happen. So it's not easy to do for me to just pick somebody and offer it to a client that I think might find it interesting. So that's my
So
background.
quickly, my name is Howard Cohen. I'm an advisor with Strategies for Wealth. I work along with Bobby Solar, and we primarily work with business owners, working with them on their exit strategy, their business continuity planning, executive benefit planning, and an array of other things, and planning for high net worth individuals, estate planning, et cetera. I'll keep it short because our time is short, but I'm happy to talk to everybody. So what I find interesting about the conversations that have taken place yesterday and today is that the discussion of managers has come up multiple times, starting with yesterday and just what Ellen spoke about with due diligence. And it's great that Marie's here because one of the, and correct me if I'm wrong, they were talking about yesterday, under a certain amount of investment, people were putting their good faith into who was suggesting that the fund investment, and then being surprised afterwards because due diligence wasn't done properly or done at all, because they said that, you know, it's only $5 million or so. Why should we spend the time? So Maria, I would like you to kick off on that, about the importance of, no matter how much family office is putting into something, why due diligence is important.
Well, I mean, unless you're just like playing the roulette wheel, right? I mean, if it really is just play around money, then, you know, but I mean, it could have other ramifications besides losing the money, right? I mean, there could be reputational issues. There could be, yeah, some sort of big blow up, and now all of a sudden, you know, everybody's in the news. So I think it really is important, you know, and what I do is from the legal perspective. So I read the documents, and it's surprising how little attention people often pay to the documents. It's crazy, right? So, I mean, just reading them over, does the strategy, I can't comment on whether or not the strategy is going to work. I mean, I can look at what they say their track record is too, but does it make any sense? Like, what they're suggesting, does it make sense? Are there factual type statements supported? Or are they just, you know, throwing stuff out there and there's no, you know, there are no footnotes or anything? I mean, the terms are important, but the terms really are what they are. And someone said that earlier, another speaker, is like, well, how, you know, do you really care how much the fees and percentages are if you're making enough money? If they're making a tremendous amount of money for you, you know, does it really matter? So I had sort of a list of things I look at here. Oh, one other thing I should say is that we do like 3 different levels of review. Most people just want like a red flag review. You know, read the documents, let us know like what stands out as being off market or, you know, really doesn't make any sense. Then we have sort of the larger institutional investors that want, you know, we do a table of like all of the sort of important terms, even if they're not off market, just kind of red flag the ones that seem to be a problem. And then we have those really large institutions that they have to go in front of an investment committee and they need like a whole memo, you know, so they need like a 20-page memo on everything that there is to say about, you know, about this fund. Some of the other things I look at are, how about the service providers? I mean, if you remember with the, you know, the Madoff situation, right? The service providers just didn't make any sense. They weren't well known. They weren't service providers that were actually in the industry. There's somebody's, you know, brother-in-law. How many principals are there? You know, there are problems if there's just one, because what happens if that guy gets hit by a bus? I mean, obviously there's key man provisions and everything, but you know, or just starts going off the rails. But then there's also problems if there are several, because what happens if they stop getting along, which, you know, does happen. And then, you know, what else are they involved in? The conflicts of interest. So those are the primary things I look at from the legal.
Can I, I'm just gonna add on, because we just did this together for a long time. So I would say to everybody, from Marie's standpoint, when you're on the due diligence, when you start looking at a strategy is when you start doing due diligence. Before you get to start paying Marie's very low fees.
I love this guy.
You know, no, seriously, I mean, because due diligence is also on day one, whether what you're investing in, does it make sense? What are the key points of failure? What are you actually betting on? And understanding that is not on your fact sheet that they email you. That's, to me, it's all integrated. It's one end to the other, and there's not, I think, too many, I'll just say, other firms compartmentalized it, and somebody on a different floor doing one thing. Like, no, it all has to fit together. So the key points of failure, they may be in the document Marie sees, but they also may be a part of the strategy which has failure points. So Madoff, I was going to say that was your inflection point. Everybody followed everybody. It wasn't just little things. But so we got pitched Madoff 3 times, and honestly never did due diligence. I traded options for 12 years, supposed to be an option strategy. They sent us the information. They sent us the performance, which of course was great.
But it didn't make any
No,
sense,
but
right?
month to month, if you looked at the market and the strategy, and we're like, no, they should have lost money here. They should have made money there. So that was just a filter where we're not going to waste time on something we don't understand. So let me just, my last word on that. If you've decided you're not going to invest in something you don't understand, then your due diligence starts there. If you want to give your money to Steve Cohen, who, by the way, is fantastic, but he won't tell you what he's doing. We never gave money for him, just for that reason. I don't know how he makes money, and he's not going to tell me. So if
He doesn't know how to pick pictures.
No, I'm saying for our purposes. I'm not telling what anybody else, you might have a different reason, but for our purposes, including due diligence, if we can't understand it and then go full blown to what Marie does, don't do it.
So that leads into Ellen, and
Well,
which you do.
I wanted to say that, as we all know, that a lot of people originally, when they want to get their money managed, will go to a money manager at a large bracket firm, which is the right thing to do, and they have a basic portfolio. It's basically robo-advisors. We all know about that. We want to have a little this, we want to have a little that, and it makes great sense. It's a balanced portfolio, and they do a pretty good job, I think, about making a balanced portfolio, and that's great when the markets are moving around, and most any time. What I happen to do, and I'd already done that, and found that the excitement for me and the fun was finding little niches, which a lot of the people here spoke about, that are special. Kevin does a lot of that, where they find wonderful little things that you won't find at a Morgan Stanley or a JP Morgan or whatever necessarily. But they're just interesting, and they could make a lot of money. We lose money, and that's why we need people like Maria to do all our due diligence and kick the tires. And people like me that sometimes they call us placement agents, because people come to us and say, please help us raise money. We have our own due diligence through our broker-dealer. I have to personally do a lot of it, meet the people, go to the office, make sure they're real. But then I have to check all the boxes with our, due diligence people at the broker-dealer. So it's a whole different world. It's more like what you said when you were, yes,
Can I
Kevin.
make a note that I just want to compliment what you're saying? I gave a talk years ago. You know what's amazing? You guys are talking about due diligence, and I know you're going to go to something else. Before you leave it, my whole talk was you got to perform the same level of due diligence on the charities that you give millions of dollars of as the companies. And you know what? That's a niche for you guys, in my opinion, because people give $5 and $10 and $20 million on a water pump. It doesn't even work. Okay? It's amazing to me. I'll leave it at that. I don't want to take anybody's time.
I always believe that as an investor. I saw people giving money. Now, if you want to give money to Lincoln Center, then that's a different animal.
Yeah, right.
Okay? That's one thing. I know you're giving money to things that you want something actually to happen. So the money doesn't just flow out the door and something happens. So it's like
$5 million, put 5,000, somebody on a plane, and check it out.
So the last word, Kevin, is because we both know each other and you invest too. Why don't you have the same process for philanthropy you have for investment, except the only difference is monetary return isn't what you're. That's all I'm saying. I think we're saying.
To your point, Kevin, I just heard that what Oprah Winfrey was trying to do is give money to the people for Hawaii, to Maui. $1,000 a month until, and that's to your point, because we all know that,
What am I?
I'm not gonna mention the large
Charities.
philanthropy organizations, but the head guy might make a zillion and you start saying, what I really meant by giving my money was to make something happen, to really help someone. Good point, Kevin.
And don't, when you see that balance sheet with a lot of money, don't think they're in great shape. They may be reserving it, okay? Quick, I'm sorry to do this. Gates put money into a company in Seattle. I visited the company in Seattle and I said, you got 10 billion, whatever you got in a thing, give us a little piece for something that's really worthwhile. It turned out to be the Pure Filter from Procter & Gamble. And he says, no, you don't understand. We have a 5-year contract. I said, what does that mean? He said, well, we got to have our salaries for 5 years.
Gates said this?
They said it.
Oh.
By the way, Kevin, so that actually transitions, because we talk about a lot, hedge funds and stuff. It isn't just hedge funds. And so Kevin kind of knows, and it was a nice lead because, so take a venture capital firm. You're still investing in a manager. And it's worse. I'll tell you why it's worse, because it was the 5-year thing that got me going. It's like, this isn't a hedge fund you can pull out in 3 months.
Right.
You're
in for 10 years.
No, you're getting
or
married
12
longer
years.
than most people ever stay married. And so when you go in and the 5-year thing is that, ask yourself, can they live for 5 years? Because you're still gonna be there. And it also goes back to fees, and it's kind of counterintuitive because a lot of them charge money for committed capital. I don't know if I'm getting a little off track, but it's a point. So if you're a big VC, you shouldn't charge a lot of money for committed capital because you have an organization and you have a third fund and you can do this. But if you have an early stage VC, you want to pay them management fees. You want to make sure they have the lights on, they can hire who they need, that they're not counting nickels while they're trying to invest your money.
And one more
Kevin,
thing.
comment.
The reason why my family office veered to direct is because during the Great Recession, on page 65 of every document, Cornell, okay? Every document, it says, if the fund feels a little insecure, and they never define it, we can keep your money and we don't have to make distributions. I'm sorry, it's in all the documents. Is it not? I mean, not every document, but most documents.
Anyway,
So you're subject to the whim of those people. You give them their money and they think that's their money.
One of the terms that I think is really important to discuss, and there's not a right or a wrong answer, is the recycling provisions, right? So when there's an exit during, let's say, still during the investment period, an early exit, can they reinvest the money or do they have to distribute the money? Or is there some middle ground? And some investors they don't want, to turn the $100 million fund into a $300 million fund. And some investors say, make my money work as hard as it can. So there's not a right answer to that, and it depends on what you want, but you have to really
I
read
think
the
it also
document.
depends on, honestly, it depends on the strategy. Is the strategy amenable to that? Or like you said, do they just want to keep your money? Because sometimes you do want them to reinvest, and sometimes no, you don't just get to keep my money.
Right, but for example, I'm working on a lending fund that's a portfolio company lending fund, and if they're gonna be short, some of them are gonna be short loans. Yeah, I think you do want them to reinvest because it's going to be, it's gonna be quick turnover.
Right.
Why not make the money work that hard?
Actually, specialty lending, just to that point, we built, we didn't go on a fund to fund. We built managed accounts. This is 12 years ago, 10 years ago, we were doing it then. For pensions, because of that, because you do it once, you do all this work, and then you get all your money back, and you want to do it again. So they wanted something that would recycle, that would actually have duration.
At your discretion.
Well, I mean, we built a portfolio for them, and they said, okay, so, but they wanted that mechanism at that point, because getting your money back didn't work, now what? But that's.
But you have to really
No, but
read
that
the
can be the
document
opposite.
to figure
I'm
out
saying.
what it is that they're going to do. Exactly, like a
Page
middle
65.
ground is some of the funds say, I want to reinvest, I want to recycle just the amount of the management fees and
Yeah.
expenses. So if it's a $100 million fund, we're going to invest $100 million. So that would be like one of those middle grounds.
So I want to bring it back to a discussion from the previous group on AI. Ellen, let's start with you about, you said you look for niches and things that are out of the box a little bit. So AI is in the box now, it's very, very much part of the box, but asking you about that and following up with Marie about the legal aspect of if someone were to come to you with a company that has a big presence in AI and they're looking for investors, how is that different than looking at companies, different types of companies?
I'm not really sure how to answer that. I don't know that much about AI. I'm fascinated. I've played around with ChatGPT, and
I'll jump in, I can
Okay.
jump in.
Neural
So
network.
I agree with the person on the previous panel who said that we might be a little overvalued on that one right now. But I think there's, it's on the worst picker there could be, because on at least 2 occasions when I thought this is the most, amazing niche, next thing coming, it went to 0. And I think that both of those things will eventually come around. In one case, it was, a competitor came in and had something better. And I'm always reminded of, Betamax. And I don't know how many people are old enough to remember Betamax, right? Yeah, a couple people raised their hand, right? But I mean, you could put a lot of money into that, but then all of a sudden, the next thing came along, the other videotapes came along and
MySpace, anybody old enough, remember MySpace?
MySpace.
Should have been, Facebook shouldn't have existed.
But you're like too early, And the other one, I think will eventually come along. It was some kind of, bazooka honey or something, and only grew in 3 acres in New Zealand, but, okay,
Can't change that.
right. Right, except that New Zealand then passed some regulation that they couldn't operate the way that they
Oh,
wanted
that's
to
not gonna
operate,
happen.
which may or may not have been in the risk factors. So I think whereas on the other hand, on AI, it may be overvalued, but maybe it's not. Maybe it really is like the next thing that is still so undervalued. So I think it's really hard to choose. You gotta go a little bit more down the center and maybe have a little play money in these other things.
Can I change the conversation
that's
just a little
exactly
bit?
it. It's gotta be play money.
This may be more helpful because, and if Marty wants him to have my half an hour AI tutor for family offices thing, that's a lot less technical, but we're not doing that here. Just make it very simple. AI is a tool. It's a tool. It's not an end to something. It's a tool set. So you don't get a hammer and nail and go, what the hell am I gonna do with it? You have a house to build or whatever you do. Then it's 2 different tools because it depends what you want. Either it's a tool that actually saves you time, organizes information better than a human can, or it's an end. And I think he was talking about looking at patterns and things that humans hard to see because there's so much data out there. And by the way, there is a difference. Machine learning, what I'm old, I wrote neural networks. Now they have to add a cool word. It's called deep learning. It's the same thing. It's a cooler word, I have to admit. They're slightly different because machine learning is more directed at the target, where neural networks let them go figure it out. But that's also a problem. You have no idea how it makes decisions. So then on the flip side, if what you're doing, you need to figure out whether it's right or wrong. So everybody knows the super simple examples that take 1 minute each, because everybody knows this already. So I'll have to explain. So we all know OpenAI passed the bar exam. So newspapers, all of that. So somebody said algorithm. I'm just going to correct terminology. Actually, it's not an algorithm. AI is a framework. You start it with an idea for it to then go work from. So, but the bar exam is a fixed result. You know what it is. And even better, you go to Marie's house and get all the information you want on LexisNexis because it's probably in her basement. So we know where the data is. Data is terribly important. And we know what we want to do. OpenAI did pass the bar exam. They had to retrain it 4 times though. And they knew it failed.
You know what's interesting? You were talking about inefficiencies. The gentleman with the beret who I've met, and I can't remember his name. My niece tells me last week, she says, you know what I do? She's a software engineer, full stack, by the way. When you're a full stack software engineer, you're the top of the line. She says, when I develop a program, I put it into chat and I make sure I don't have any defects. So it's a tool to find out what's wrong with your program. Interesting. I don't think that's maybe shocking to you guys, but I thought that was really fascinating.
Kevin, the trick that people need to plan on with chat, ask it the right question. If you don't answer the right question, you're not getting the right answer.
Okay.
So anyway,
But
that's
it's a
little bit of
real
aside.
tool for inefficiencies.
Yeah, we'll go back to managers. No, the manager part is once again, you go into the strategy, somebody says AI. Okay, ask yourself, where's your data? I think artificial intelligence is a bit of a misnomer because without massive amounts of data, you can't train an AI. So do you have data? Do you have to get data? Is it expensive? So I'll give you a super simple example because then we don't have a long conversation. TikTok is a great AI. You know why? Because it's creating massive amounts of data every minute, every time somebody uses it. In 10 minutes of looking at you, I've never been on it actually, use me, it'll start showing me stuff that I like because it figures that out. But unlike the bar exam, what if it's wrong? A, who knows? B, who cares? The only thing that matters if it's wrong all the time, it's a piece of junk, but there's no consequence to it being wrong. And so when you're investing in something, AI is terrible for perfection. So you wouldn't want it to replace your air traffic controller. But what I would love to see, AI air traffic controller, that's a tool that looks at things and flags the controller about stuff maybe they didn't see. They're two different things, but they're the same thing. If you understand, one's an end and one's a tool. So when I say whatever you're looking at, ask yourself that question first. And then go from where's the data? And then how hard is it to train? And how expensive, by the way, NVIDIA H100 chips aren't cheap. Does that help?
Can I just interject one
Sure,
thing? On
please.
what Anthony was saying about asking ChatGPT the right question. I actually had a client, we have a lot of clients that would rather ask them than ask us because it costs more money to ask us. And he asked me the question, I answered the question, he said, that's wrong. ChatGPT says this, I said, did you ask it this way? And so then he asked it that way and says, oh, okay, you're right.
Marie, you gotta use
Should
the
we use
story of
GB
the lawyer.
Should we use GBT to pick our managers?
We can get into that. if
Probably
you
not
want.
any worse than the rest of us, right?
No, but for Marie, there's a fantastic story. There was this lawyer, by the way, it's a great tool probably to save Marie a lot of work because you can look at all the casework and you can get it.
I've never used it yet,
No, I'm
and I
saying,
hear it makes up cases.
You can do it, but wait, the flip side is, it's right in the newspapers.
Yeah.
This lawyer didn't do Marie's work and actually made his case and put it in the court. And the judge said, this isn't even real.
The cases were
And
made
then,
up.
by the way, he only got fined $5,000. I thought he should have been disbarred. I don't know, you're the lawyer.
I think
but
he was,
I
I
should
think
have
you
been
were
disbarred.
suspended for 6 months. And
I don't know, you're not, anyway. So that's a tool versus, no, you don't want it to be your lawyer, as far as I can tell.
A little bit on this subject, a little different than manager selection, is that I know people that use ChatGPT for NDAs. Is this gonna favor me? And it'll write back, I'm not an attorney. If you were an attorney, would it favor, the recipient? Well, no, because of blah, 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 blah. How would you reframe it? And it will do
It's a
that.
tool.
yeah, it's a tool.
And only if you read it at the end, unlike that lawyer who just sent it to the judge.
So we've been talking about ChatGPT and AI, et cetera. How important is, as a manager and vetting managers, is diversity? Diversity in investments, et cetera.
It's
Diversification.
imperative. You have to.
Diversification, yeah.
We all know of people that put all their money in the basket of their employer, won't mention, but large corporations, and it's doing great, putting all my pension in it, and it's double, and they're gonna match it, and then, woof, lo and behold, they're then at the time to retire, there's a hiccup in the market, and it's not looking so good. So that's why it's important to have a basic portfolio, well diversified. What I do isn't for everyone. It's only for people that have the passion and the wherewithal to look outside of just a plain vanilla balanced portfolio by the managers. And there are extra niches that you can do really, really well, but it's also a risk.
And can you just say something about your resources? Because diversification is also resource constrained. How many things can you actually do good work on? I mean, just reflect on it.
Personally?
Yeah, it's not a loaded question, it's an actual question.
Well, it's not how many things. I don't take in, I'm very persnickety
Okay.
about the issues that I take in, the opportunities. For the very reason that it takes a lot of work to do the due diligence.
Yeah.
And I have to personally feel that it is a business that could do very well, that I would put my own money in, and often I do if I can, if I'm liquid. That I think, ooh, I like the managers, there's a lot behind this, it's come well recommended, I go through the whole process. So I don't handle a
There's
lot.
different ways is my point, that's why I was asking you.
Sorry?
I said there's different ways of getting there, that's why I asked you.
Yeah.
Because my flip side, coming from the office world, I go into a bank, and diversification, by the way, was a major part of what we do. But I've got a global bank with towers in every major country in the world. And I've got a platinum card that nobody ever tells me when I've hit the limit. 3 million frequent flyer miles, and that's one aspect. But let me then narrow it down. We're talking about, because it's easy, because the last conversation. Direct lending, do us a favor, throw the word out. Specialty finance, right? When you want a car loan, you don't just go anywhere. You go to somebody that does car loans. So I'm oversimplifying that part. But if you build a series of them, I don't know if you do 1, 2, 3, because we did it, I don't know if you remember fixed income alternative program, we're just trying to get off the ground. Anyway, there you have these different slices. And diversification did not come because they were all lending. Diversification was determined by cutting across 7 different lending things and looking for common risk factors. Interest rates, defaults, credit risk. So if you build it so those things don't overlap, then you're creating diversification, even in a narrow space. Or you can just do 5 of everything, which I don't know why you do that.
But if
That answer
if
the
it's
question?
all lending, it's still gonna be affected by the macro
Interest
aspects
Some yes,
that-
some no.
Yeah,
For instance, reinsurance is counterintuitive. It does better when interest rates rise.
okay.
By the way, I think Suzanne was talking about capacity. If you watch the AUM go up, your returns will go down because they are capacity constrained. Marty,
Can we talk about due diligence and this whole crypto issue we were talking about yesterday and we've been talking about for a while now about
specific to specialty finance or something else?
specifically to FTX and
FTX?
right, and the fact that,
Oh.
you know,
So
it's out of favor, et cetera, but I mean, I
Yeah.
think it's the issue, let me just.
I have an easy answer, but if you want.
Let me posit the question first, and then you can answer it however you like, but the
I have an
question
easy one.
is, how did everybody miss FTX? Does anybody do due diligence? And if the due diligence is so faulty, why should we ever trust them again?
Because no one did due diligence. So anyway, but my easy answer was a friend of mine who runs a pension fund. They didn't have FTX, by the way. Had to make, this is after FTX, had to present to the board what happened. So I've known her for 20 years, AIG and whatever. So I said, put the mindset in something they can understand. So I wrote, I don't like to publish stuff. You guys can have anything I write, but Michael likes to do white papers and publish. I'm not an academic, he is. But the ideas don't change. I wrote a note about 1 page. And I'll just tell you the title without spending 20 minutes on what it said. It said, if FTX was a hedge fund. Go back to these ladies here can adjust to it. It's a list. It's Marie's list. There's no financial due diligence person here. I guess I'm it. You know, it's a list of things, and truthfully, hedge funds did them all. Counterparty agreements, bilateral collateral, risk management, leverage. They didn't measure any of that, Marty. Nothing. And I said, if it was a hedge fund with all of what we're talking about here, it never would have blown up.
Well, and that's because of the many, many years that venture capital funds and funds like that have been excluded from the same regulatory requirements as hedge funds. So my question is, do we expect it to be a higher?
But crypto is a whole different animal too, and I think to a certain extent, people didn't really know how to do diligence. I mean, they didn't even try, but they weren't sure what they should be
They just
looking
should have
at.
come
It's like,
to
it's a totally different
Come to
animal.
this meeting and take the hedge
Yeah.
fund playbook, and I'm
Basic
telling you that we
tenet,
need it
guys.
never.
Basic tenet,
The basic
but I'm
tenet
the one
is
who raised the
crypto.
question, so can I talk? My question was, from a legal point of view, when when you're giving money to a VC who says his differentiation is that he does due diligence that includes looking at the software. And by the way, you could tell from doing the due diligence on the software, since we own firms that do that, you could see the problem with the software. Now, the fact is, they did not do it from A to Z. Yet they represented that they had the expertise or would get it to do it. They did not do their job.
And the question.
The question was,
did
is
they
the
care?
LP,
Did they care?
the question isn't that. The
Okay.
LP is sitting there a victim of a lie.
You mean Sequoia?
No, I'm
Okay.
talking about
No,
another
just according to
VC.
GP.
The
person who's
the
invested in-
LPs are expecting that the GP did due diligence.
Exactly, right. That's why you
They
hire the
did not
GP.
do it.
Sequoia
The
was an
question-
LP in FTX and they wrote a paper.
I'm telling you, the
Fine.
LP
No,
is
no,
in a
no,
VC.
let's not be
Trying to get
funny.
your question, Mark.
Okay, if, the LP is in a VC XYZ, who's not a big name.
Right.
Okay, smaller firm. The question was whether or not the LPs, and you're gonna tell me it depends on what the document says, but conceptually, it was a oral misrepresentation that they would do it, they never did it, they invested money, and the LP lost.
Wait, hold on one second here.
Operational failure.
One
It's the
second.
same-
Gudrun is, there's actually a chain of GP responsibility, because just because you're a small LP, if you're co-investing with a larger GP, right? Then they're responsible too. Somebody has to have done the due diligence.
It's the same
Can
problem
I
as
say what I
with
was
the
about
fund
to
of
say?
funds. Wait, let me just say one thing.
Yes.
It's the same problem that with the fund of funds and Madoff, right? The fund of funds represented that they had done the due diligence. They didn't do the due diligence and there were a ton of lawsuits.
Similar concept. Crypto is built upon not knowing what's going on. I wanted to do a coin with some guys, and I said, but it's coin with a cause, so I want to make sure that X percent of the proceeds go to the cause. And this guy who's on CNN and all these things says, you don't understand. There's never a cause.
It's an easy answer, right?
Doggy coin had nothing to do with dogs, Kevin. It's not, the whole concept of crypto, it's changing now, was don't ask questions. Because 80% of the investors in crypto are, quite frankly, over in Asia, who want to put their money into things that there are no questions asked. So the whole concept was secretive. And therefore due diligence is it's like, you kidding me? You're gonna do due diligence on us? Don't be silly.
And Kevin, can I reduce your comment to just literally one sentence?
Yes, sir.
I don't know if everybody knows what a stable coin is.
Just one sentence, please.
It was a question, then the sentence. So you're tokenizing the US dollar. And I think 5 of them have failed. If you can't tokenize a US dollar, what else can you tokenize without collapsing that?
Fantastic. What were your?
That was a sentence.
What was your comment?
My comment?
Yeah.
So I was just, I was just saying that, I was just making the due diligence comment. It depends on whether they represented that they did due diligence, and I would assume that they did. I mean, if they said, we don't know what they're doing, there's no way to tell what they're doing, it's a complete black box, you wanna put your money in, well, then I don't think
Good
that they have a claim.
And
To some
can we
extent,
also
that's
talk
it.
about the Silicon Valley Bank meltdown, and should we really reconsider venture capital investing? And again, we had Silicon Valley Bank at Lowenstein in 2005 pitching, talking about, and obviously they became a very different company. But, how does that impact your
It's an
worldview?
anomaly, though. I'll tell you why. It's an anomaly. Look, I invested in venture companies for decades. It's an anomaly because when you give a venture company 40 million, pick a number, they don't normally put it in a checking account. The only, wait, let me, one more sentence, Marty. Normally, interest rates are not zero, so they put it somewhere with interest-bearing rates. Interest rates were zero, so they left it in a checking.
So the conditions that created Silicon Valley Bank, I was at Wilson Sonsini's office when everything was crashing, right? And they were doing a partners meeting every night for 3 hours a night, all on board, right? And they said that the issue is that Silicon Valley Bank was giving people loans at prime plus 1. And the typical venture lending loan is prime plus 15 plus warrants. Right? So anybody would sign the Silicon Valley Bank agreement,
But they had deposits they never should have had, that's what I'm saying.
which is a violation of typical due diligence. You wouldn't allow them in the hedge fund space to put all your money in one place, to not have more than, to have less
The
than.
government 2 years at zero, the bank
Brokers.
account's at zero, yeah, nobody cared.
So I'm saying, there should be some regulatory framework around that, and how does it impact your viewpoint towards venture?
Well, normally interest rates aren't zero, at least if you live
That's
long
right.
enough. So it doesn't happen before.
Doesn't matter if it's 0 or whatever, it's prime plus 1.
The loans are only
That's the
based on
question.
their deposit base. If they didn't have a deposit base, they can't fuck up the loans.
No, as soon as a venture-backed company would get $10 million or $50 million from Sequoia, they would get a loan equal to 15% or 20% of that amount, right? And now that's the standard. That's also the reason why they didn't have CFOs
Marty,
on these firms.
Manager selection, one example, 90% will get it. Silicon Valley Bank shouldn't have been in that business. Avenue Capital had 2 venture lending funds. This is good, solid, I mean, they're super reputation. They actually stopped doing it about a year ago. They had I think they had about 600 million. They underwritten beautifully. I mean, this is Avenue Capital. Silicon Valley Bank, they're amateurs. Avenue's not. So that's the difference.
What I'm
does
positive is
not
that
change
no
my view
bank
of
should be
venture,
in what
though. I mean,
Silicon
I
Valley
think
Bank
venture-
was
It's manager selection. I mean, I'm being
No,
general.
I'm saying no bank should be doing what Silicon Valley Bank was
I
doing.
said that.
Right, you said Silicon Valley Bank. No bank should be doing
Why,
it.
Marty?
It should be out of the industry,
Because
which means you have to look at
trying
the
to shorten
industry
the conversation.
differently.
Silicon Valley Bank's whole pitch is, we're a cash flow lender and not an asset lender. That's the old CIT formula. That's where Silicon Bank, we don't care about your assets, we care about your cash flow
Marie, your
projections.
perspective from a because you're like the, you know regulation unbelievable, right? So you're the regulatory perspective.
I'm not down on venture. I mean, I think venture is a significant, should be a significant asset class. And I mean, it's done very well over time. I think there's certainly some inflated values, but the thing I would watch on venture is, the drift. Sometimes the venture funds themselves don't understand the regulation, and to be qualified as a venture fund, you have to have at least 80% of your assets invested in, primarily issued equity securities of startup companies. And they go like kind of off into the, into the twilight, and they really should be registered advisors, and they don't even, realize that.
And the flip side, hybrid hedge funds, which I've seen them blow up, I think 3 times, 10 years apart. Tiger Global is a hedge fund trying to get rid of all their VC stuff now. That's a disaster. Have you done hybrid funds?
Mhm. Yeah.
Because to me, it's a train wreck. Anyway,
Mhm.
if you have an opinion,
Sometimes.
please.
No, I mean, sometimes it is. It depends on, again, what they're doing. If they're just like drifting off into, designated investments or side pockets or whatever, and they're doing all kinds of things in there, well, that's probably not what the investors
But was
signed
your
up for.
structure set up that way? So they could?
Well, sometimes they have the ability to side pocket something if it becomes illiquid.
That's
That's totally different. But what they start potentially using it for sometimes is, oh, we want to invest in these private companies, and that's not what it was designed for or to do. So that's, again, something to look for in the documents or in the actuality,
Yes.
So, last question I want to ask, and you can run through it real quickly, maybe, is track record. When, as a manager and as somebody who's doing the due diligence, how important is the track record of the niche fund that you're looking at, or the niche company that you're looking at, and the companies that both of you are dealing with?
I think that all boils down to the manager, him or herself. And that's why it's very important to actually meet them, to see their office, to see who works there, to see what's really, really happening. You don't want to wake up and find out it's, you went to Oz and behind the curtain, there's nothing. You really want to know, and I personally, I have a smaller business, I take them to lunch. I don't want to do a Zoom call again, and everybody's got their notes, and this is what I did last year and the year before, blah, 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 blah. I want to know a lot about them. I want to know something about the family. I want to know, kids go to school, where they went to school. Yes, okay, I can study the business, and I have people that can help me do that. But I want to know the person. Is this somebody slippery? I want to hold onto my wallet when I leave? Or is this someone that I go, this is a great person. This is a great guy, gal, that I trust. I put my own money with. That's how I do it.
I'll give you 3 questions to ask yourself instead of advice. First of all, we went through 10 years of 0 rates. Now, I don't know what the future is, but we don't have that now. The context of the track record you see against the past opportunity versus the current opportunity. The process and experience, throw the numbers away. In fact, I don't look at numbers first. Process experience applicable to the strategy, which, like I said, I left fund of funds, zero opportunity, zero rates, zero defaults, zero volatility. Terrible for hedge funds, good for privates. So it's context of, don't just look at numbers and chase numbers. By the way, we've mathematically proved that sucks as a strategy. I'll send you something if you want. But with that said, is that it's a balance between they just suck. That's the bottom part. No, that's track record matters. But also on the upside, did they hit some environment or certain thing where they were like the bee's knees, but it can't be replicated. So track record is a tool set that you have to understand the strategy. And by the way, we were macro top-down views also, the environment, you got to put that together. It's not just one thing.
All right, I'm gonna add one more thing on to
Go on.
what Andy says. He's talking about the environment. You also have to look at the team. Are we talking about us, the same team or very,
Experience.
very, very similar team that's on their third fund and this is what their last two funds? Now, even if it's the same group and they're on their third fund, you still have to look at the macro, experience that you can expect. But oftentimes it's not the same team. It's like somebody who came out of one group and now, they're trying to tout their prior experience with a whole different group, which of course, the SEC doesn't endorse, but you still see it. So you got to dig down a little bit from the macro and the micro perspective.
And I go back to specialty lending. Don't use the word direct lending because every lending is a specialty. To Marie's point, everything's a specialty. So if you're, I met a great fund in Chicago last week. They do middle market PE. Don't do anything else. Not big ones, not small ones. Their processes were excellent. The returns weren't so great because zero rates and free financing. That party's over. It ended at the beginning of 22. So I love them on a going forward basis because they knew how to do workouts of bad loans. By the way, ask a new lending fund. I'm like, what? Nothing to work out. I go back to maybe an Avenue Capital, whoever. Something names people didn't know. You don't know these guys. I'll send you their names if you want. They really knew what they were doing. They've been doing the same thing for more than a cycle and been successful and had workouts and done that and everything that you need. But they weren't out student loans or anything else.
So I think we have to wrap
Yeah,
up
nope.
now. Yep, great.